Hi everyone, if you're new, well, I'm glad you found my channel. What I try to do here on my channel is explain that investing in the stock market is more than just buying a company you love and that's it and thinking it's going to go to the moon. There are a lot of people who are going to get crushed by this mentality and I'm trying to avoid this. Look, maybe you're a little concerned that something doesn't feel right about all the hype around Bitcoin or Tesla. Well, you're not alone. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy the entire company and run it ourselves. And today I'm going to do a quick high-level valuation of a company called Kelly Partners Group, as it is investing with Frank's favorite company, and I want to see whether it's worth my time seriously researching it. Now, I'm not going to do a full analysis here. I don't have the time to seriously analyze thousands of companies out there, so I'm trying to filter out as many as I can using this method. Even if the company passes or fails this quick valuation, it doesn't make it a good or a bad investment. It's just a way to motivate me whether I want to go onwards and do further research and study the company in serious detail. So just sit back and follow along to learn how to do this yourself, and we will have a target buy price by the end of the video. This is part art and part science anyway, and the more practice we do, the better we're going to get. Okay, now to do this high-level valuation, I'm going to go through my 9-point checklist and then give you my opinion at the end. All right, let's just jump straight into it and talk about what is KPG, or Kelly Partners Group. So they're a small Australian company and they're buying accounting firms, and what they do is they take a 51% stake in the company and leave the 49% stake to somebody who already is at the company, and they're making these acquisitions and sort of rolling them up together and creating efficiencies by owning multiple accounting firms, these small, medium-sized accounting firms. The cool thing about accounting firms in Australia is that the clients that these accounting firms have, they hate to change accountants. They hate it. They won't do it. Even if the prices are 30% more or 30% more at their current one, they're probably just going to stay there, because once your accountant develops a relationship with your business, they understand, they get quite efficient at doing your bookkeeping every year or doing your taxes or whatever it is. So the clients are actually really sticky, and this is a really attractive part of the accounting firm industry and accounting firm business. So I like this idea as a whole. Okay, it's a small cap company. As you can see, enterprise value is about 210 million. All right, first thing we're going to look at is the revenue growth. So we want to see revenue growing. Obviously, it means the business is getting bigger. That's really all we need to see here. So what I do is I go over to the income statement and I look at the revenues. And since 2016, it was 21 million. Now it's around about 46 million. Done. That's a tick. Revenue is definitely growing. Okay. Then we look at the gross margins, and the gross margins, if they're improving, it means they're getting more efficient, the business, and they're hopefully being able to charge a little bit more money as well, and their clients aren't leaving them. So gross margin growth is a sign of they have a strong competitive advantage. So they have been growing their gross margins, as you can see, from 2016, it's around about 50%. Now it's about 53%. I know that's very small growth, at least it's stable anyway, and it's slight growth, so we can give that a tick. Cool. Return on invested capital. So what we're going to do is we're going to go into the ratio section here. I'm in TIKR Terminal at the moment because this is an Australian company. I like using Morningstar for my US companies, but TIKR is a great platform for those who want to get the financial information of foreign companies. It's probably the best platform I've seen for, it's the best platform out there in my opinion. So we've got return on equity, return on capital, return on assets over the past 5 years. Look, these numbers are very impressive. So return on equity, look, it's always been around about 30 to 50%. They had the one bad year in 2017. Maybe there was, I don't know, some big acquisition and their revenue was flat for whatever reason. Look, 1 year out of 5 being that low is not a problem at all. Return on capital, look at those strong numbers, all in the 20s, even up to 30%. Return on assets is solid as well. This is a really well-performing, great performing company. This is very attractive. I can see what Investing Frank has been talking about. That's very cool. All right, let's move on. Debt. Now we want to see the current ratio over a 1.5. Debt is the problem with companies because it's how they're going to go bankrupt if something goes wrong in their industry, or this is how they're going to get into some sort of trouble. So we want the debt to be, current ratio to be over a 1.5. So I go to the balance sheet And so I look at total current assets, and it's at the moment, it's 14.6 million. Total current liabilities is actually it's only 19 million. So current assets are smaller than current liabilities. That's a problem. That makes it around about a 0.7 rather than a 1.5. It means that I would say this is the issue here with this company. Now, I would have to go into serious detail into this balance sheet and look at what the debt actually is and how big of a problem it actually is. Maybe this is not an issue at all if I actually did the work and dug into the balance sheet. But this is a high level approach. We're just trying to see what's going on here with the company. So I'm definitely going to give that a cross for now. Now, the next thing we're going to look at is the free cash flow. So that's operating cash minus capital expenditures. So this is essentially what's left over for us as investors, and the management team can do lots of things with this money. Free cash flow is fantastic. It's really what we want to see, because they can give us dividends, they can do share buybacks, they can pay down their debts, they can do lots of things with this free cash flow. So what I'm going to do to find free cash flow is I'm going to go to the cash flow statement, and what I'm going to do is I'm going to look at this number here, cash from operations. Okay. As you can see, it's been growing very strongly from a 3 million to a roughly 16 million for the trailing 12 months. And we minus this capital expenditure row here. Now, capital expenditure, as you can see, has been really stable. It's somewhere between 1 and 2 million for the last 5 years. So as cash from operations get bigger, the capital needed to run this business isn't really changing dramatically. So this is an amazing sign. It means the free cash flow number at the moment is around, well, it's probably around about 15 and a half, roughly, maybe $15 million. And yeah, this is fantastic. This is really good to see the capital expenditure staying the same and cash from operations getting bigger. That's really attractive. Okay, I don't see that very often. So that's a big tick, that one there. All right. Now I want to talk about my brokerage accounts, because not all brokerage accounts are made equal. Robinhood, Webull, all those other app type ones, they've got no long-term history whatsoever. They're not stable. They're probably going to come under some regulations. The people who are running these companies haven't been doing it for very long. Look, I don't trust them. That's as simple as that. I want companies that have been doing this for decades and decades. I can look at their financial statements. I can look at the stability. They're backed by governments. They've got really low fees. Interactive Brokers is my number one pick because they don't have a monthly fee anymore. It's fantastic. There's a link in my description if you want Interactive Brokers. Yes, it is an affiliate link, but it's the account that I use. So I'm very happy supporting this company. Saxo Bank, I also have an affiliate link. They're my second account that I use. No issues there with them as well. The fees are just a little higher. So Interactive Brokers first. If you're looking for a second account, please use Saxo. Both access international markets, and that's very important, especially if you want to buy something like Kelly Partners Group. All right, shares outstanding. Now, the shares outstanding is just the number of shares that are out there available for everyone to buy. And if this number is getting bigger, well, that's a big problem because we're getting diluted. And if this number is getting smaller, well, that's really good news because our value in the company is getting stronger. So to find this, normally I have a few ways to find this, but I'm just going to look in the balance sheet and I'm just going to look at the common stock number here. And it looks like it has been slightly declining. At least it's flat. Total shares outstanding on filing date, well, it doesn't go back in time. So I probably need to go back through some financial the annual reports, probably back from 2016, and quickly just check the shares outstanding number. It's going to take a little bit of digging, so I won't do that now because this is supposed to be a quick valuation. So we'll give it a tick. We probably should give it a question mark, but we'll give it a tick for now. Something we should probably dig a little deeper into. Not a big problem at the moment. Insider ownership. This I think is very important because we want the incentives of the management team aligned with us as shareholders. If the management team have a big stake in the company, maybe they get a salary, but if the shares that they own is more important than their salary, well, they're going to try to make this business grow just as much as I want it to grow as the shareholder. So to check that, what I do is I go over to Simply Wall Street and I have a look for look here, Brett Kelly, the founder, Kelly Partners Group, it's named after him, obviously. He owns over 50% of this company. He is massively incentivized to make this a successful company, and that's brilliant. That's all I really need to see. That's That's one of the highest insider ownerships I've seen. Normally you see like Dropbox, I know Drew Houston is 20%. I thought that was pretty high. This is 50%. This is fantastic. All right, give that a big tick of approval. All right, let's move on. Super investors. Now these, I'm not that smart, and I would love to see someone who I think is one of the best investors in the world, Charlie Munger, Monish Babrai, Warren Buffett, any of those guys. I would love to see them invested in this company. Unfortunately, this is a small cap Australian company, so we're probably not going to see that. This is just a filter that I like to use to reduce me being an idiot, pretty much. Because if someone else has done the work and they've got decades of experience and they're far smarter than me and they've invested in this company, well, that gives me a lot more conviction in my own understanding of the company. So I couldn't get information about this because it's a small cap Australian company. Brett Kelly owns half the company already himself, so there's not much left over for everybody else. So there's no gurus in this one. All right. Price versus value. This is where it gets significantly more important than everything else we've seen so far, because price is what makes or breaks the investment. A great company, if we pay it too much for it, is going to be a bad investment. Just like you buy anything. If you're going to buy an iPhone, but you're going to pay $10,000 for an iPhone, well, that's a bad deal. You shouldn't be paying $10,000 for an iPhone. They're worth about $1,000. But if you're paying $500 and you're getting 50% off somehow, well, then that's a great deal and that's a better investment. We're doing exactly the same thing here for a company. So what I'm going to do is I'm going to use my intrinsic value calculator, which is going to help us work out a buy price and give us also some, how I'm going to show you how to calculate my margin of safety. Now, growth rates for the next 1 to 5 years. So if we have a look at the revenue growth, the operating cash growth as well, that was growing at, look, it's nearly doubling. It's not quite doubling, it's probably growing at 40-50% for the last 5 years, which is exceptional. Now, revenue was only growing at around about, you can see the change percentages here. We've got 3, 43, 31, 16, a bit lumpy, but somewhere between 15 and 20% is probably the number here. Now, I have done a little bit of digging into this company, I will admit, and I do know that they're aiming for 15%, and they're trying to be quite conservative with that number. I'm going to give them the benefit of the doubt and say they are going to keep that going at 15%. Now, normally I would slow the business down a little bit, but I'm not going to slow this down too much because the more accounting firms that they get, the better economies of scale they get and the more efficiencies they can drive into this business. So I'm not going to slow it down too much. I'm actually going to just call it 13% for the 5 years after that. I'm pretty confident with that. The more acquisitions they do, this is going to, I feel like they're building quite a fortress here. So I'm not too worried with it slowing down dramatically to say 5 or 10% or anything like that. I'm going to call it 13%, a little slowed down. Okay, my return on investment goal. Now I'm aiming for somewhere in the 20% range is what I want to get from my investments. But I put in 30% because that allows me some margin of safety. It's to stop me being stupid and buying something overpriced, because if I can get anywhere near aiming for 30% discount rate with quite conservative numbers, it's a screaming deal. So I aim for 30% as my discount rate. It's like I'm going to shoot for the stars and I might hit the moon kind of style strategy there. Okay, now if we're growing at these 15, 13% growth rates, we're going to at least get a 15x multiple. I think we're probably going to get a little higher than that with those growth rates, and we're probably going to get something closer to 18. 20, maybe pushing it a little bit. Let's stay on the conservative side and call it 18. Okay. Operating cash flow minus maintenance CapEx. This is free cash flow essentially. Sometimes this maintenance CapEx number is just hard to find, that's all. So I'm going to do the shortcut, which is just get the free cash flow. So that is this cash from operations. Now we're going to look at the last 12 months minus the CapEx number, which is 1 million. Let's just round that down to 15 for now. I'm happy to call it 15 million. Now these are going to be all in Australian dollars. Okay, so the shares outstanding, I think it was 45 million, I think it said. Okay, yeah, 45 million in the shares outstanding. Okay, then we go look at the total cash that they have on their balance sheet. So they have 4.34 million in cash, and then how much debt they have. They have quite a lot of debt. Like we saw earlier with the current ratio, debt is probably my concern here. They have a lot of debt. They're probably using it to do the acquisitions. It's probably fine, but I need to do some digging here in what this debt actually is. So they have 27 million in debt. Okay, now that gives me a buy price of around about $2.50 Australian. And if I go have a look at the current price, obviously depending when you're looking at this company, well, at the moment for me, it's about $4. So I would have to give that, that's going to give it a cross in the price. And that's a bit of a pity because I'll be honest, my opinion of this company is that, look, the growth has been great. It's a small cap company, which I love because it has a lot more room to grow. Those return on invested capital, return on equity numbers are fantastic. Free cash flow was really strong. That was fantastic. Remember seeing that operating cash minus CapEx number, and that CapEx was like stable, yet the operating cash was growing. That's incredible. I love seeing that. It means they're not having to spend much money to make more, which is cool. The shares outstanding I need to look into a little bit more, but to see if that's stable or not. The inside ownership was really strong. That 50% that Brett Kelly owns, fantastic. This is definitely worth digging deeper into this company. I might have been way too conservative with these numbers. Maybe buying a really great company at a fair price is not that bad. I really want $2.50. I probably should have looked at this a little earlier, but that's okay. I'm going to add this to my watch list and hope that price does come back a little bit. Maybe there's some issues in the global economy, nothing to do with this company. Yeah, and I can get a price that's a lot more attractive for me. But the thing I do need to do some work on is understanding that debt. That debt it looks like an issue at the moment, and I really want to understand what the debt is, and maybe they have really good favorable interest rates. I don't know. I need to understand more about their debt. I also would like to know about Brett Kelly himself. I haven't studied him much personally. He has a big chunk of the company, but what is his long-term view of the company and how does he want to grow this business? How does he think? Does he think really long-term and doesn't really matter about the short-term? Is he building a fortress? What's the runway for growth? I probably need to understand the total addressable market a little bit better to understand how big the accounting industry in Australia actually is. I am Australian. I do know it's pretty big. I think these guys are only in New South Wales and Victoria, which is only part of Australia. Again, really need to understand how big that market potentially could be. And I really just need to find out what could possibly go wrong here in this investment. It's probably the debt is the issue here, but I need to understand that. I'll probably talk to some people like Investing with Frank about what could also go wrong. But yeah, I get it. This company is fantastic. I got a bit more work to do, but yeah, I'm really on board. I like this. I want a better price, but yeah, something that I would highly recommend adding to your watch list. Do some work on it. And if you have done some work on it, please let me know in the comments. I'd love to chat to someone else about it. And if you like this video, please make sure to give it a thumbs up before you go. Subscribe if you want to hear more types of analysis videos like this. And I will see you next time.